If you look at overall media, I don't think we're growing the pie at all. I think we're looking at different ways of accessing the content. Clearly, the old adage of content is king still holds true, but it's a question of how we access that and who has that content ownership. Netflix spends 7 to 8 times more on content than Apple, for example. I think Disney have a very broad offering now from November this year with Disney Plus, but actually there are a lot of Me Too products that are out there in the market. You have cable light services from Dish, from DirecTV, from YouTube even, which now costs $50 a month. So I think that already Netflix has the mind share, but how this plays out over the next couple of years will depend on who gets to the scale numbers of subscribers.
But one number that jumped out to me, I saw in some of the company notes, that the time that is spent on Netflix makes up 10% of total television watching, 2% of mobile viewing. It's not very much. It does make you feel as though, given how popular Netflix is, that there might be more room for improvement on those viewing hours.
Although if you look at it on a global basis, in terms of their number of subscribers that they have, you could also argue that one of their latest shows had 3 times as many watchers as the new Game of Thrones episode, for example. So it depends on how you slice and dice that marketplace. But obviously the race now is to get to scale, and you also have to remember that Netflix has just posted the biggest number of net subs I've ever seen since they went public.
I think one of the biggest questions is the underlying business of Netflix, especially when you compare it to an Apple or an Amazon. You know, Netflix burns through a lot of money and its margins are not great. So when you're looking at this, as an investor, how do you really say Netflix has the same future that an Apple or an Amazon does in the longer term?
Yeah, I think the jury is out on that. I mean, there are definitely believers because the stock trades on 75 times forward earnings, 10 times sales. But there are obviously questions about how the approach will play out in long term, and it's not obvious to say how that will pan out. Clearly, Amazon's kind of ultimate negative working capital, the business that they have with the Prime membership, clearly is a differentiator for them. Apple have a walled garden approach with a very high Apple tax, which, don't forget, Netflix has now circumnavigated the Apple App Store, but hasn't seen a hit to their own subscriber numbers, despite no longer paying for that service. So there are ways and means of how this market plays out, but clearly there's not everyone is a winner, despite the fact that there are many broadcasters trying to get a piece of this particular pie.
Neil, one of the big questions as we talk about recession, we just heard from Eric that he's forecasting a mild recession in the US coming up. How recession-proof are these over-the-top streaming services? Are we going to see consumers trade down to them in a downturn in the economy, or will they start to filter through and weed out some of these subscription services?
Well, I think we talk sometimes now about subscription fatigue. I don't think that consumers are willing to pay for all of the services that are available, and there will be a finite bundle they'll be prepared to pay for. But clearly there is an opportunity here that you could have, if you like, you could have Hulu Plus for younger content, Netflix for older content, ESPN Plus for sports content, and overall that's going to be a cheaper option than it is for a cable bundle.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.